Investing is a powerful tool that can help individuals grow their wealth, achieve financial independence, and secure their future. However, navigating the world of investing can be complex and challenging, with numerous potential pitfalls along the way that could derail a comfortable retirement. While making mistakes is a natural part of the learning process, some errors can prove costly and hinder long-term financial success. Watch this video to learn about some of the most common investing mistakes and how you can avoid them, empowering investors to make informed decisions and maximize their chances of building a profitable portfolio. Stay to the end to hear about one mistake seemingly everyone makes that can be detrimental to success. One of the most significant mistakes investors make is jumping into investments without conducting proper research and due diligence. Investing requires a thorough understanding of where money is going, whether it be stocks, bonds, real estate, or index funds. Failing to research the fundamentals, analyze historical performance, and assess potential risk can lead to poor investment choices and substantial losses. By dedicating time to research and staying informed about market trends, you can make more educated investment decisions, greatly increasing chances of success. Furthermore, investors should also focus on understanding the financial health of the individual companies or assets they're considering investing in. This involves analyzing financial statements, assessing the management team, and evaluating the competitive landscape. By delving deep into the details, investors can gain valuable insights and make more informed decisions. Investors should feel confident in their choices and not make purchases based on a hunch. Emotions play a significant role in investment decisions, often leading to irrational choices that can harm long-term gains. Fear and greed are common emotional triggers that cloud judgment and prompt investors to make impulsive decisions. Panic selling during market downturns or buying into a stock solely based on hype can result in substantial financial losses. Reacting to negative or positive news headlines can also cloud judgment, leading to knee-jerk reactions. To avoid emotional decision-making, it's crucial to adopt a disciplined approach, establish investment goals, and stick to a well-defined strategy. Investors can mitigate emotional biases by setting clear investment criteria and following a predefined set of rules. This might include determining the maximum percentage of one's portfolio that can be allocated to a single investment, having a predetermined exit strategy, or seeking advice from a trusted financial advisor. Remember that scary news headlines are designed to stir up emotions, and there will always be something to fear. Try to ignore these short-lived emotions and focus on the big picture. Putting all your eggs in one basket is a recipe for disaster when investing. Failing to diversify your investment portfolio leaves it vulnerable to losses if one asset class or industry underperforms. By diversifying across different sectors and asset classes, you can mitigate risk and protect your investments. A well-diversified portfolio provides a balance between risk and reward and can help safeguard your investments against unforeseen events. Diversification involves spreading investments across various types of assets, such as stocks, bonds, real estate, and commodities, as well as across different industries, and avoiding becoming overly concentrated in an employer's stock, for example. This strategy helps reduce the impact of a single investment's poor performance on the overall portfolio and allows investors to benefit from the potential upside of different sectors or asset classes. A well-diversified portfolio provides the potential for stable returns, and it helps investors navigate market fluctuations with greater resilience. By adopting a diversified approach and sticking with well-rounded choices like broad market index funds and ETFs, investors can increase the likelihood of achieving their financial goals and weather the challenges that investing presents. Attempting to time the market is a perilous undertaking that even experienced professionals struggle with. Market timing, which involves trying to buy at the lowest point and sell at the highest based on short-term market movements, is a strategy fraught with challenges. Consistently and accurately predicting short-term market fluctuations is extremely difficult, if not impossible. Investors who actively try to time the market often find themselves missing out on potential long-term gains or making untimely investment decisions that can negatively impact their portfolios. Instead of getting caught up in the elusive pursuit of market timing, a more prudent approach is to focus on long-term investing. By adhering to a well-defined investment strategy that aligns with financial goals and risk tolerance, investors can withstand market volatility and benefit from the power of compounding over time. Embracing a patient and disciplined mindset allows investors to recognize the futility of market timing and instead stay invested through market cycles, capturing the potential rewards of long-term market trends. Trying to beat the market is a common pitfall that many investors encounter. While the idea of outperforming the market and achieving above-average returns might be alluring, it's important to acknowledge the difficulty even seasoned professionals face in consistently surpassing market performance over the long term. The pursuit of beating the market often comes with several drawbacks and risks. The desire to outperform the market can lead to poor investment decisions driven by speculative or short-term thinking, as investors might be tempted to chase after the latest trends or hot stocks. Instead of solely focusing on beating the market, a more prudent and realistic approach is to stick with a reliable investing strategy that aligns with long-term goals. Attempting to consistently beat the market is a loser's game. Successful investing requires patience, discipline, and a long-term perspective. It's important to understand that investing is not a get-rich-quick scheme, and expecting immediate or consistently high returns is a common mistake that can lead to disappointment in hasty decision-making. Financial markets are characterized by cycles of growth, stability, and decline, with short-term fluctuations being an inherent part of investing. It's crucial for investors to avoid the temptation of constantly monitoring their portfolio and making frequent changes based on these short-term market movements, as this reactive approach can undermine long-term goals. By staying focused on long-term objectives and adhering to a disciplined investment strategy, investors can weather market downturns, avoid impulsive decisions driven by short-term fluctuations, and increase their chances of achieving investment success. Embracing a patient mindset allows investors to navigate the complexities of the market with resilience, confidence, and the potential for long-term financial growth. Relying on hot tips from friends or family or following the herd is a dangerous investing mistake. By the time a tip reaches the general public, the opportunity for significant gains usually have already passed. Moreover, blindly following the crowd can lead to speculative bubbles and herd behavior, where investors inflate asset prices beyond their intrinsic value. It's important to critically evaluate investment recommendations, conduct independent research, and make informed decisions based on your own financial goals and risk tolerance. Investors should be cautious of investment fads or trends that promise quick and unrealistic gains. Conducting thorough research, analyzing the underlying fundamentals, and evaluating the long-term viability of an investment are essential to making informed decisions. Seeking advice from trusted financial experts or professionals can also provide valuable guidance to avoid falling into the trap of following the herd. Investing can be a rewarding journey when approached with knowledge, discipline, and a long-term perspective. Avoiding common investing mistakes is crucial for building a successful portfolio. Remember, investing is a continuous learning process, and staying informed, adaptable, and committed to a well-defined investment strategy are key attributes for success in the ever-evolving world of finance. By avoiding these mistakes and continuously improving investing skills, investors can pave the way for long-term financial prosperity.